I don't write these books and go through these scenarios and not provide some solutions. I think that's unfair and it may be a little irresponsible. So there are some things that can be done at the policy level to prevent this from happening. Again, just to illustrate this, I'll use a metaphor. So you're on a mountain, it's snowing and snowing and snowing. The snow is building up, a big snowpack is building up on the side of a mountain. And any seasoned mountaineer can look at that and say, that's going to turn into an avalanche. That's unstable, it's going to collapse. It's there for now, but it's inherently unstable, it's going to collapse, right? And then one snowflake comes along, perturbs a few other snowflakes, it lands the wrong way, they gather momentum, it becomes a chute, it becomes a slide, momentum builds, the whole thing rips loose, kill some skiers and bury the village below. That's the dynamics of an avalanche collapse. Exact same thing in financial markets. It only takes a very small initial event, maybe one Italian bank or Deutsche Bank, which would be a pretty big snowflake, or failure to deliver physical gold because there's a physical gold shortage in the world that becomes public and starts a gold buying panic, natural disaster, a political assassination, something. It could be a lot of things that are the snowflake. But go back to the avalanche. You go up in high ridge lines in Switzerland or Colorado early in the morning. What is the ski patrol doing? The ski patrol's out there with dynamite, shooting cannons and setting off dynamite charges to break up the snowpack. So what they're doing, as a physicist, I would say, they're descaling the system. They're breaking up little avalanches so the big avalanche doesn't happen, making it safe for the skiers in the town below. Now, bring that over to the capital markets. We should be descaling the system. That means, number one, separating commercial banking and investment banking. So in the US, bring back GlassSteagall. That worked brilliantly for 66 years, from 1933 to 1999. Why on earth did the Congress in 1999 think that they were smarter than the Congress in 1933? I mean, why did they enact GlassSteagall in the first place? Because in the 1920s, the banks went out, they originated garbage loans, securitized them, sold them to their customers. And then it crashed in 1929. We went into the Great Depression. Congress had hearings. They said, that's an inherent conflict of interest. From now on, you can take deposits and make loans, or you can underwrite and sell securities, but you may not do both because there's an inherent conflict of interest there. That was GlassSteagall. In '99, the Smarty Pants Congress, led by Phil Gramm, a Republican, and signed by Bill Clinton, a Democrat. So that's the other thing. The Democrats and Republicans are in this together. This is not left versus right or Republican versus Democrat. This is elites versus everyday people. That's what's going on. So Phil Gramm, the Republican leader, and Bill Clinton, the Democratic president, get together and they repeal GlassSteagall. What happened next? Banks originated garbage loans, securitized them, and sold them to their customers, and the system collapsed. It was an exact replay of the 1920s. Why are we surprised? The bankers will do this every time. So break it up. So first of all, go back to separation of commercial banking and investment banking. In the UK, pre-Big Bang, 1985 was the Big Bang. That was the GlassSteagall here. Go back to those pre-85 rules. Number two, break up the banks themselves. When I started in banking, today's JP Morgan was 5 giant banks. They were all big. It was the old JP Morgan, it was Chase Manhattan Bank, Manufacturers Hanover, Chemical Bank, and a couple others thrown in there, okay? Yeah. So break them up again into 5 banks. And the metaphor here is to take a vessel, a ship at sea. They have watertight compartments. So you punch a hole in a vessel, one compartment will fill up, but the vessel won't sink because those bulkheads keep the water from spreading to the rest of the vessel, right? Same thing in banking. Break up JP Morgan into 5 banks or more. If one of those banks fails, too bad for them, but the whole system doesn't go down. Third thing you do is ban derivatives, all of them.
All of them?
Yes, look, here's the thing. I created the sovereign credit default swap market. I mean, I did the first one. When I was at Long-Term Capital with a trader, we were the largest.
What was it on, Korea?
Italy, actually.
Oh, Italy, okay.
We were the largest trader in Italian government bonds. Actually, the Italian Treasury, this was not known at the time, the Italian Treasury was an investor in long-term capital management. So we were joined at the hip with the Italian government, right?
More elites.
So they're an investor. We had all the elites. So the Italian Treasury is an investor. We're the biggest trader in their bond market, right? And we had an Italian trade that just was a money machine. I mean, it just always made lots and lots of money. But we were so big, we said, well, there's one, because we could hedge the currency risk, we could hedge the interest rate risk, we could hedge the market risk, but we couldn't hedge the sovereign risk. We said, well, if Italy defaults on its debt, we're out of business. Now that was a very low probability event, but the consequences were catastrophic. So our guys who like to hedge everything said, well, can we buy insurance on Italian government default? So we found, it was the Milan branch of Sumitomo Bank. They had lots and lots of Italian liabilities. They were willing to take on some Italian assets. So we did $1 billion Italian sovereign credit default swap, first one ever with Milan Branch Sumitomo.
With Sumitomo.
I had to write the contract. And at this time, there were no forms. And today you have ISDA forms, and you pull a form off a shelf and sign it, and you're done.
Right.
We had to do it from scratch. So my job, I didn't price it. That was this guy, Arjun Krishnamacharya, did that. But I had to.
I priced it like this.
I had to think
4 basis points, you're done.
Well, we paid a lot of money
really?
for the protection, but that was, you pay for insurance.
Yeah.
So I had to think of every possible way a government can screw you over. So like
repudiation.
Repudiation. That was easy. Okay, they don't pay you. Got it. Okay. What about 100% withholding tax? So here's your money, but there's 100% withholding tax. The net to you is 0. What about capital controls? So here's your money, but you can't leave the country. Come and get it. You know. Yeah. What about hyperinflation? You know, and on and on and on. So there was just every way that they could screw us. I had to write them all down and invented this. And then not long after. Gillian Tett has a great book. Gillian Tett of the Financial Times wrote a book about Blythe Masters and the team at J.P. Morgan. And what they did, we did the first contract. They created the market. We were just doing a one-off trade, you know. But they then had this idea, same idea. You know, a lot of times this was kind of in the air, and they turned it into a huge market. And you know, credit to them for doing that. But so I'm a little bit like Dr. Frankenstein. I created the monster. I'm telling you that we should ban derivatives. When I went out and created some of the biggest new products in the market, but I actually understand them better than most people. I think I have more credibility as a critic, having been very deeply involved in the creation of these products.
Right. Continue watching this fascinating conversation for free by clicking on the link below to visit our website, learn from the best minds in the world, and connect with a community of passionate people building the best versions of themselves. Just click on the link below, and I'll see you on the inside.